routine?
I just read and read and read. I probably read 5 to 6 hours a day. I don't read as fast now as when I was younger, but I read 5 daily newspapers.
Warren Buffett once said that he spends 80% of his day reading. Imagine the power of knowledge when it comes to investing. Are you ready to tap into his wisdom? Imagine having the ability to analyze businesses like Warren Buffett does. Imagine being able to spot incredible investment opportunities that others might miss. Today, we'll unlock the secrets that can make this dream a reality. Get ready to unlock the secrets hidden within the pages of The Warren Buffett Way, as we explore the 5 invaluable takeaways that can transform your investing journey. But this is not just another boring finance video. Instead, we'll be following the different stories to learn different key takeaways from this timeless classic that will help you become a better, more successful investor. So sit back, relax, and let's dive into the world of investing. The first lesson is, don't buy a stock, buy a business. Imagine you're in the small town of Omaha, Nebraska, back in the 1970s. At a local cafe, you overhear a conversation between 2 friends, Warren and Charlie. They're discussing a company named See's Candies, renowned for its delicious chocolates. Intrigued, you listen intently as Warren Buffett explains his unique perspective. Warren Buffett: "You know, Charlie, when I buy stocks, I don't see them as mere tickers on a screen. I see myself as a business owner, with a stake in the company's success." Charlie Munger: "That's an interesting way to look at it, Warren. But isn't investing just about buying and selling stocks?" Warren Buffett: "Not for me, Charlie. I believe in investing in businesses with strong fundamentals and long-term potential. See's Candies is a perfect example. It's not just about the chocolates, it's about the entire business behind them." Warren Buffett's philosophy teaches us that successful investing involves understanding the underlying businesses behind the stocks we purchase. Viewing stocks as ownership stakes shifts our focus from short-term market movements to the long-term value and profitability of the companies. Let's come back to our story. Warren recognized that See's Candies had a loyal customer base, a strong brand, and a reputation for quality. He visited the company, tasted their chocolates, and spoke with the management team. His diligence revealed a profitable business with growth potential. Now imagine you're in Warren Buffett's shoes. When you invest in a company, ask yourself, do you believe in the business? Do you understand its products, market position, and competitive advantage? These are the key questions that can guide your investment decisions. This approach can help you make informed investment decisions and foster success over time. Now you understand that don't buy a stock, buy a business. So the question is, how to choose a business for a better investment? That we will learn in our second lesson, how to choose a business. Imagine it's the early 2000s, and Warren Buffett is having lunch with his friend Bill Gates, a billionaire investor. As they discuss potential investment opportunities, their conversation takes an intriguing turn. Bill Gates: "Warren, I'm looking to invest in a technology company. Do you have any recommendations?" Warren Buffett: "Well, Bill, before we dive into specific companies, let's talk about what I focus on when choosing a business. One crucial aspect is understanding the business itself. Warren Buffett believes in investing in businesses that you can understand. This means choosing companies whose products, services, and business models make sense to you. By doing so, you can better evaluate their potential for success." Let's come back to our story. Warren recalls a time when he considered investing in a technology company called XYZ Tech. Although XYZ Tech was a leader in the industry, Warren found their business model to be complex and hard to grasp. Warren Buffett: "Bill, I couldn't fully understand how XYZ Tech operated. It was outside my area of expertise, so I decided not to invest. As an investor, it's crucial to focus on businesses that fall within your area of understanding. Don't get swayed by hype or fear of missing out. Instead, seek out companies whose operations, products, and industry dynamics you genuinely comprehend." Apart from business quality, Warren Buffett places great importance on the quality of a company's management. But it's not just about competence. It's also about how management behaves and handles mistakes. Let's come back to our story. Warren recalls another investment opportunity where the company's management made a significant mistake that resulted in financial losses. However, what impressed Warren was how the management team took responsibility for their actions and learned from their errors. Warren Buffett: "Bill, it's crucial to consider management behavior. It's not about never making mistakes. It's about acknowledging them and learning from them. A management team that takes responsibility and adapts is far more valuable. Lastly, Warren Buffett emphasizes evaluating a company's financial quality before making an investment. Warren remembers analyzing a company's financial statements and discovering excessive debt, poor cash flow, and inconsistent profitability. Warren Buffett. Bill, financial strength is vital. Look for companies with manageable debt, consistent cash flow generation, and sustainable profitability. These factors provide a solid foundation for long-term success. As you embark on your own investment journey, remember Warren Buffett's advice. Evaluate business quality, management quality, and financial quality. Invest in businesses you understand, seek out competent and accountable management teams, and analyze the financial health of the company. These considerations will guide you towards sound investment decisions. The third lesson is how to use a margin of safety to avoid financial disaster. There was a young investor named Sarah who was eager to make her mark in the world of investing. She had been following the success stories of legendary investor Warren Buffett and wanted to learn from his wisdom. One fine day, Sarah stumbled upon a fascinating company called XYZ Inc. Its innovative products and soaring stock price caught her attention. Intrigued, she decided to explore further and see if she could benefit from this investment opportunity. However, before Sarah made any rash decisions, she remembered one crucial principle advocated by Warren Buffett: the margin of safety. Warren Buffett believes that a margin of safety is crucial in investing. It serves as a cushion, protecting investors from financial disaster. But what exactly does it mean? Definition of margin of safety. The margin of safety is the difference between a company's intrinsic value and its market price. It provides a buffer, allowing investors to weather unexpected challenges and minimize the risk of permanent loss of capital. Let's see how Sarah used the margin of safety in her investment decision. Sarah diligently researched XYZ Inc.'s financials, analyzed industry trends, and assessed its competitive position. She determined that XYZ Inc.'s intrinsic value was higher than its market price. Sarah had an aha moment. She recognized that by investing with a margin of safety, she would be protecting herself in case of unforeseen challenges or a decline in the company's stock price. Sarah saw that XYZ Inc. had a strong balance sheet, consistent cash flows, and a promising growth trajectory. However, she noticed that the stock price had temporarily dipped due to a market downturn. Remembering Warren Buffett's teachings, Sarah decided to proceed with caution. She calculated the margin of safety and determined the price at which she would feel comfortable investing. Sarah waited patiently until the stock price of XYZ Inc. reached her predetermined price, allowing her to buy with a sufficient margin of safety. As time passed, XYZ Inc. weathered the market storm, and its stock price rebounded. Sarah's disciplined approach and the margin of safety she had built into her investment decision paid off. Remember, my dear viewers, the margin of safety is a powerful concept that can protect your investments and enhance your chances of long-term success. As Warren Buffett wisely said, rule number 1, never lose money. Rule number 2, never forget rule number 1. The fourth lesson is Warren Buffett's 5 investing principles. Warren Buffett's 5 investing principles. But before we jump into it, let me share an incredible real-life story that perfectly captures these principles in action. Are you ready? Let's dive in. Imagine a small-town investor named John. John was passionate about investing and wanted to build wealth over time. He came across a company called ABC Corp. And decided to investigate further. Little did he know that this journey would teach him invaluable lessons based on Warren Buffett's investing principles. John began by being a business analyst, diving deep into ABC Corp's fundamentals. He analyzed their financial statements, studied their industry, and understood their competitive advantage. He realized that ABC Corp was a solid business with strong growth potential. This brings us to the first principle. Principle 1. Be a business analyst. Warren Buffett advises us to be diligent business analysts. By thoroughly understanding a company's operations, products, and market dynamics, we can make informed investment decisions based on the underlying strength of the business. Now, John faced a decision. Should he invest in ABC Corp or look for even better opportunities? He remembered the second principle. Principle 2. Choose the best Warren. Buffett emphasizes the importance of choosing the best companies to invest in. John carefully evaluated ABC Corp's competitive advantage, growth prospects, and management team. He realized that ABC Corp ticked all the right boxes. Excited about his findings, John decided to take a leap and invest a significant portion of his savings in ABC Corp. He understood the third principle. Principle 3. Bet big when it's time to Warren. Buffett encourages investors to bet big when the opportunity presents itself. John recognized that ABC Corp was undervalued in the market, presenting an excellent buying opportunity. He took a calculated risk and placed a substantial bet on the company's future success. Soon after, the economy faced a downturn, causing panic among investors. But John remembered the fourth principle. Principle 4. Ignore the economy. Warren Buffett advises us to ignore short-term economic fluctuations and focus on the long-term prospects of the businesses we invest in. John remained confident in ABC Corp's underlying strength and resisted the temptation to sell during the market turmoil. Years passed, and ABC Corp's stock price soared. John was tempted to take profits, but he remembered the fifth and final principle. Principle 5. Hold good companies forever. Warren Buffett advocates holding on to good companies for the long term. John realized that ABC Corp had become a truly great company. He decided to hold on to his investment, allowing the power of compounding returns to work its magic. John's journey perfectly encapsulates Warren Buffett's 5 investing principles. By being a business analyst, choosing the best companies, betting big when the time is right, ignoring short-term economic fluctuations, and holding on to good companies forever, John was able to build significant wealth. Thank you so much for joining me today on The Wealthy Listener. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell to stay updated with more valuable content. Until next time, keep investing wisely and building your wealth.